Hello. Welcome to Forex Central YouTube channel. Your way to financial freedom. For more information, make sure to check our other videos in this channel. Before you continue, make sure to like, press the subscribe button, and hit the notification bell icon to receive notification updates every time we upload new videos. Claim your Forex trading course tutorial videos for free. Just press like, subscribe, and hit the notification bell. To receive your free Forex courses, please send us your email address at forexcentralofficial@gmail.com with screenshot of your visit in our YouTube channel. We will send it through your email. Thank you. Now let's go for today's video. Forex Central gives special credit to Mohsen Hassan, CEO of MTG, for sharing his expertise and knowledge in Forex trading. Your dedication and commitment to educating others are truly appreciated. We are grateful for your contribution to this Forex Foundation training course.
So it's finally time to start looking at charts, which is what technical analysis is, right? Some people call technical analysis the study of charts, which is what it is. Now, that being said, what type of charting software are we going to use? The one I'm going to recommend right now is going to be TradingView. TradingView is the most popular charting software in the world right now. Now, that being said, depending on which trading platform you're going to decide to use, so example, if you decide to use MetaTrader 4 to enter and exit your positions, you can do your charting right away in that platform. And I am going to show you also how to do your charting through MetaTrader 4. But you might decide to use another trading platform. You might decide to use MetaTrader 5 or CTrader or whichever platform that your broker offers you as well. Well, for that reason, I want to show you also how to use TradingView, since TradingView anybody can use. And also everything that you're going to be able to do through the charting here, you can do in any other charting software. Another reason why I like TradingView is because you can do the charting for everything else within TradingView. So I do my charting for stocks, for cryptocurrencies, and for Forex through TradingView, which you can't do through MetaTrader 4 because MetaTrader 4 is just for currencies. MetaTrader 5 has more options. But that being said, when you're learning, it's very good to learn on TradingView. You can also do the charting on your platform as well, and you can see which one you like best. And in this course, I'm going to be showing you TradingView, and I'll also go over MetaTrader 4 later on in the course once we get into the trading platform. That being said, TradingView has a lot of different things that you're going to like as well. When you go on their main page, there's a lot of things that you can see here. You can follow people, there's top authors that you can follow, you can look at their analysis, you can comment, you can read other people's comment. So it's a very good place for you to learn. There's calendars in here, there's a bunch of things. There's screeners, Forex screeners, crypto screeners, there's a bunch of things, and then you have your charting. So if I go on my charts here, okay, you're going to see one thing. Top left, you're going to be able to put the currency that you want to look at. Example, if I want to look at USD CAD. When I put USD CAD, you're going to see it gives me, well, first of all, I can select what am I looking at? I'm looking at Forex. Well, in Forex, I have 4 different things here. Why? Because they're coming from different brokers. So here I'll be getting the prices from FXCM, here from Oanda, here from Forex.com. So I want to get prices from Oanda. So I click on Oanda, I have it here, right? Let me just change it. If I go back, USD CAD, I want the prices on Oanda here. So I have my charting that's coming directly from the broker Oanda. Now, if your broker isn't there, it's okay. You can select another broker. The prices will vary between brokers by maybe 1.5 pip, not more than that. So it doesn't really matter too much. But if your broker is listed on there, select that broker. And you can look at your chart here. Now, the really nice thing here with TradingView is I can create different lists. So example, I have lists for cryptos, for stocks, for US, for Canada, and I have one for FX. I can go in, let me go in pairs. Here I have some cryptocurrencies. I go FX, I have all of these. And I can just look at charts by clicking on them very quickly. And you can add different currencies here. So if I remove USD CAD, if it wasn't there, you can have your list here and add different currencies. I can put USD CAD and add it here. Then it becomes very easy to have multiple currencies. You can also click here on layout and have different layouts. Example, if you want to look at 4 currencies simultaneously, I can click on this, select which currency I want to have where, and then look at multiple currencies simultaneously, right? Which is super nice. Now, there's a bunch of other things that you can do, which I don't want to jump into right away because I want us to look at the basic charting, but then we'll look at some other things that you can do that might be very helpful to you. So that being said, if you don't have an account with TradingView already, make sure you go right now and open an account with them. There are several subscription packages. The first one is free, so you can just use that one if you want. I have the pro version because I'm using a bunch of the other bells and whistles, but start off with the free version only if you start wanting to use something and TradingView actually tells you, hey, sorry, this is only available for pro or premium users, then start considering upgrading, but start with the free version right now and play around with it a bit as we look into the next lectures. In this lecture, we're going to look at candles, candlestick charts, and line charts. Now, whenever I pull up a chart, or whenever you see charts online, you see these things here that are composed of some green things and some red things. Well, what are these things? This is what we call candles. And all of these candles compose a candlestick chart. So it's a chart of candles. Now, what is each of these candles? Well, a candle is basically a representation of the prices in a given period. So let's say I want to look at one day, the period of one day, today. Well, I'm going to look at the candle. And the candle is going to give me the first trade of the day. So the first execution of the day that happened, the price of that. So if the day we started at $10, let's say, it would have a $10 opening price. Now, throughout this one period, this one day, prices will fluctuate. Maybe this currency is going to go up, so it's going to be 10 for, it's going to go up to 12 for one, and then it's going to go down to 9 for one, and then come back to 10 for one, and then go up again. What this candle is going to show me, it's going to show me the opening, then it's going to show me the low that it had throughout this day, the high, and then the close. And this is going to be a candle. Now, if the price closed at the end of the day higher than it was in the beginning of the day, it's going to be a green candle because it's going to tell me that prices went up for that period, in this case for a day, right? Now, if the price had closed down, we would have had a red candle because in a red candle, the close you see here is lower than the open. And then there's a high and there's a low. Now, the low and high are represented by wicks. These we call wicks or shadows. And those are basically candles. So if you have red candles, you know that prices went down for this period. If it's a green candle, it went up. So when I look at something like this, well, I can say, for example, that this is a daily chart that I'm looking at. So here you can see that I'm looking at daily. That means that each candle represents one day. I can look at this candle, this is today. Well, this candle would be yesterday. You see here, it says at the bottom, the dates. So this one was May 1st. The one before was April 19th. The one before, April 30th. The one before was April 29th. One before, April 26th, because there was the weekend, right? So if I look at yesterday's candle, I can see it's a green candle. So prices went up. So in the beginning of the day, the price was you can actually tell from here. There's the open, high, low, close. So when I go over a candle, I can see these numbers changing. I can know that here it opened at 1.33904. That was the opening price. Okay. And sometimes it's hard with the mouse to get it exactly if I'm looking at here, but if I pass it on it, you see it here. Okay. So 1.33904. The high was 1.34615. And then it closed at 1.34378. So at a higher price than it opened at. Now this is because I'm looking at a daily chart. Okay. And I can look at other days and be like, well, let me just zoom out here. Here there was a lot of consecutive red days. Okay. Here as well. Okay. And I can see that some days, something might have happened this week. because we had a lot of consecutive red days. What happened? You can look at things like that and try and analyze. Now, you might not always want to look at daily charts because maybe you want to intraday trade. You want to trade shorter period. You don't want to buy something here and hold it for 3 months. Maybe you want to buy something and sell it tomorrow, or maybe in an hour. So you can select different chart length types. So for example, maybe I want to look at 1 hour charts. And then what happens is that each candle is going to represent an hour. Now look at this. If I'm looking at this chart now, each one of these candles is an hour. So I can see that this is today, May 1st at 6 p.m. This candle was an hour earlier, so at 5 p.m. This one was an hour earlier, so at 4 p.m. You can see that here at the bottom. Here we go, 4 p.m. And so it starts at 4 p.m. and it finished at 5 p.m. This candle was at 3 p.m. This candle was a bigger candle and it was at 2 p.m. So each candle is now a 1 hour candle. And then you can do your analysis because you're trading within an hour range. You can look at 15-minute candles. And in this situation, again, each candle is going to represent 15 minutes. So this one is at 6 p.m., but this one started at 5:45. This one at 5:30. This one at 5:15. So you can do different types of trading. You can do short-term trading or long-term trading. And based on if you want to do short-term or long-term, you're going to look at different time frames. So for me, I always look at the daily charts to get a global idea of the direction that we're going. But then if I'm doing day trading, so buying and selling within the same day, I like to look at 5 and 15-minute charts. If I'm looking to do a little bit longer than that, I would look at 1 hour charts. If I'm looking to do some swing trades where I'm holding for several days up to a few weeks, I'll look also at 4-hour charts. Now, that being said, those are the charts that we're going to be studying. Now, these are candlestick charts. And let me get back here to daily charts. Now, are you going to use this type of charts or other types of charts? Well, if I click here, you can see that there's a bunch of different types of charts, right? There's the candlestick charts, and then there's the line chart. Now, if I click on the line chart, you'll see that it doesn't have all this information because a line chart is basically a chart that has the close on each period. So it only connects these dots, okay? It doesn't have the high, the low, and the open as well, so you can get a more clearer picture of what happened on that day as well. So it's way simpler. Now, will you use this? Not really. You'll use the candlesticks because the candlesticks give you the most information possible. Now, the only times we're going to use line charts is when we're comparing different currencies together, and then you might want to just look at the lines to be able to compare them. But other than that, we'll always, so 95% of the time, going to be using candlestick charts. Now, some people like to look at these other chart types. I haven't had any type of better prediction value using them, and I have always used this one. And most of the traders that have traded for me or that I have encountered in other trading shops only really use the candlestick types. There's a bunch of different informations out there, a bunch of different things, but a lot of these things don't add value to you trading and will just end up confusing you and giving you more information that is not needed, to be honest. So for me, stick with candlestick charts. It's more than sufficient for everything you're going to be needing to do. In this lecture, we're going to be looking at trends and trend lines. So what are trends? Trends is basically a trend. You've heard of that before, right? There's a trend. Everybody going in a specific direction, right? So it's the same thing in currencies. A trend is when a currency is going in a specific direction. Now, you can have a uptrend, which means the trend is going up. You can have a downtrend, which means it's going down, or a side trend, which means it's going sideways. Now, an uptrend is characterized by higher highs. So you see here, there's a high. The next higher is higher than that, and higher lows. So this low, you see that the next low is higher, and the next low is higher. So when prices are going like this, that's an uptrend because each high is higher than the previous one, and each low is higher than the previous one. Downtrend is you have lower lows and lower highs. So you have a currency that's going down, and you see that each time there's a low, it's lower than the previous low, and the highs are lower than the previous highs. And side trend is basically where it's, equivalent. The highs are equal to each other and the lows are somewhat equal to each other. So we're trading in a range like this. So you might have realized or saw earlier that on my USD CAD, I had some lines here. Well, you see here, you can see that there's, some type of trend since September 2018, right? Now we're in May 2019, and there's this type of trend here. You can see that every time we have a high, and let's see if I can draw on here, or even a low. Let's just look at the lows. Every time I have a low, okay, there's a low here, but look at the next low. The next low is a bit higher. And look at the next low. The next low is a bit higher as well. And look at the next low, also a bit higher. So it doesn't have to be perfect, but you can see that each low is higher than the previous one, right? And I can see also that the highs are higher, right? Each high is a bit higher than the previous one. So what does that tell me? That tells me we're in an uptrend. So the currency is going in a specific direction. USD is strengthening versus CAD. So it's taking more and more CAD to get you $1 worth of USD, right? And you might have heard the expression before, the trend is your friend, or don't go against the trend. Why? Because it's been proven that when something is going in a specific direction, it's more likely to keep going in that direction, right? When you have momentum, when you have a force in a specific direction, let's say a train going in a direction, it's hard for it to stop or go in the other direction. You need an opposing force that has, a force equal or bigger than that force to make it slow down or change its direction. And it's the same thing with prices. So when you see that there's a trend in a specific direction, you want to make sure that you're not going against the trend unless the trend breaks. Now, to be able to have a better idea on this, what we usually do is we draw a trend line. So a trend line is basically just a line that we draw on either all the lows or all the highs. I'll explain the highs later, but let's say on all the lows for now. And this trend line makes us really see the direction of the trend and when the trend breaks. So in this case, if I have a trend line here, you can see that whatever this product is, it's going to be supported. Why? Because everybody's looking at this trend line. So every time the price hits the trend line, people know that it's going to bounce off of it. And usually prices will bounce off a trend line. But when it breaks, it'll break and it'll go in the other direction. So if we go back to our example here, I can actually look at this chart and see, well, okay, can I connect these lows here? And I can take this line tool, trend line tool, and just see if I can connect them, right? And it doesn't have to be perfect, it's just an approximation, okay? And some people don't just draw one line. Some people like drawing two lines. So they'll take one line here and they'll do like a range. They'll take another line and they'll be like, well, because usually it's a range, right? It's not a perfect science. They'll be like, this is the support level, and they'll have like two lines. But for simplicity's purpose, let's just draw one trend line, okay? And leave it at that. You can tell yourself that, okay, well, because of this trend line, I see that the direction is upward. So the next time that this currency drops here and comes here, I'm going to buy it. Why? Because everybody else sees this direction and everybody else sees this trend line. So everybody else expects this currency to bounce off of this trend line. What does that mean? That means when the price comes here, they're all going to be buying, putting pressure on this currency and pushing it back up. So some people always wonder, well, do trend lines work because they work and it makes sense? Or is it because everybody thinks that they work, and because of that, they all place orders on these key locations, and because of that, it works? So is it really something that works, or is it a self-fulfilling prophecy? Everybody says it works, so everybody applies it, and because everybody applies it, it works. And we don't know. I think it's a combination of both. Obviously, the impact of everybody following trends and using them has an impact on it, but also there's something to it as well that makes sense. So we'll be drawing trend lines to be able to look at the direction and see if it's a good place to buy or sell. In this situation, if the currency comes here, I know it would be a good entry spot for a high probability trade. And if the price breaks it, I would not want to go long this currency because there's more likelihood that it breaks down. So this is what a trend line is. In the next lecture, we're going to explain support, resistance, and channels. In this lecture, we're going to look at channels, supports, and resistance. So what a channel is basically two lines like this. So even from the example we saw in the previous lecture, you might have noticed that things, when they move in an uptrend or a downtrend or a side trend, they don't just have a line at the bottom. They have one at the top too, because it moves within that range. So I could have drawn this one here by adding another line. I could have just taken another line and connected the highs as well. And by doing that, I would have seen that the price here for this currency trades within this channel, right? And in this situation, I know that when the price comes here, there's a high likelihood of it going back down. So if I'm buying here, when the price comes here, I should sell because there's too big of a likelihood that it comes back down. And if I'm holding it, then I would have wasted all this time holding it for nothing. I could have bought here, sold here, bought here, sold here, bought here, sold here. Instead of just, imagine somebody else who just buys here and holds it. And he holds all this time. Well, he would have been from here to here, he would have been flat, not making any money. But somebody else who says, okay, well, I'm not going to buy here, I'm going to wait. And he buys here, sells here, buys here, sells here, makes way more money and is only using the capital for a fraction of the time. So it's very important to look at this type of stuff, not only for where you're getting in, but for where you're getting out. And things usually trade within that channel. And that's not just in Forex. That's across products, in cryptocurrencies, in stocks, in anything. Things are trading within a channel. Now, what do we call this bottom line and what do we call this line at the top? The bottom line is what we call support. So when people are saying, hey, it's hitting the support, it's above the support, we're talking about the bottom line. Why do we call it support? Because it's supporting the price. The price is trying to go below it, but it can't because it is being supported by this line. So we call it the support line, okay? And this is when it breaks, people say, the support just broke because the price broke below the support. Now, the line above is what we call the resistance because for the price to go over it, there is resistance, it's causing resistance for the price. So the price isn't able to go over it and bounces off and goes back down, bounces off, goes back down. So this line we call the resistance. So resistance line is the one above, support line is one below, and the price is going to move between them. Now, that doesn't mean that the resistance is never going to break or the support is never going to break. They are going to break. It just means there's less likelihood of them breaking. Now, where do we find supports and resistances? Well, we find them around trends. When there's a trend, you're going to have a support and you're going to have a resistance. But not only in those situations, we often find support and resistances around round numbers. So this is not necessarily the only place where you're going to find support and resistances. You might find a resistance at a round number. So let's say at $1.50. Here, there's going to be a resistance. Why? Because at round numbers, psychologically, it has an impact on people. So a lot of people might be like, well, you know what? At $1.50, I'm selling because it's too high. So there's going to be a lot of orders, a lot of people transacting at those round psychological prices. And same thing with prices lower. So you might say at a round number of 120 or $1 or 110, there's going to be a lot of buy orders because at those prices, a lot of demand is going to cause the currency to be supported. So supports and resistances are not only with trends, but they're just something that have to do with people placing buy or sell orders and affecting the supply and demand at particular price levels. Okay, and this happens often at round numbers. Now, the more round the number is, the bigger the impact is. At $1, that's a very big round number. $2, very big round number. Well, 150 is also round. Well, 110, 121, those are also round. 115, 120, 125 is also round. But some of them are less round than others. So again, we'll go from $1, $2, that's very round. 150, that's round. 125, that's round. But then, 110, 120, 130, those are also a bit round, less than the others. Then 115, 145, 135, they're also round, but a bit less than the others. So the impact is going to be less on those than others. But every single round number that you have, there's going to be a bit more supply demand. So bigger potential for support and resistance than at regular prices, because people don't think often of, yeah, I'm selling at 142.22. No, they'll be like 150, So you'll have a lot of support and resistance at those levels. And again, the rounder the level is, the more of a support or resistance it's possible to be there. Now, another thing that we want to look at is one of the properties for supports and resistances. And this property is role reversal. So when a specific resistance or support breaks, it actually reverses and becomes the inverse. Example, if we had, let's say, this support here that we have, and the price, oops, let me take this off, and the price all of a sudden breaks down, okay? Let me see if I can draw it here. I'll take the brush, and the price breaks down, okay? Well, what happens if the price comes back up? You know what's going to happen? This support line is now going to become a resistance, and the price is going to bounce off of it and go down, and it might bounce off of it several times. So supports and resistances tend to reverse their roles once broken. And same thing with round numbers. If, for example, the price of this currency decides to just went up and then broke, let's say it bounced off 150 a few times because it's a round number and there's a lot of resistance, but then broke over it. Well, you know what? It might now become the new support, and prices might now bounce off of the 150 in this way. Now, why is that? It might be because of a psychological effect. So people at one point were saying, oh, 150 is too high, it's too expensive, it's not going to break there, and they're just selling. But then once that breaks and it goes higher, well, when it comes back to 150, people are like, oh, it's back there, I can finally buy, it's not as expensive as before, and they start buying at that price. And this also have been proven often. So round numbers, or not only round numbers, but any support and resistance, when they break, there's a very big likelihood of them changing and becoming, the inverse. So let me, even if I check real quick right here, let's see, I'm looking at this support here, but let's say I'm looking at this one. Look at here. Sorry, my camera just shut off, so I had to replace the battery real quick. So to continue where I left off, if I'm looking at this chart here and I'm trying to find some supports and resistances, real quick here, I can see that, there's a resistance here. But look at this. When this resistance, okay, when we broke over it, look at this, it became the new support and prices started bouncing off of it, right? Now, I'm just looking at this real quick, but often what you're going to find is things are going to trade in ranges. And when they break the range and they go in another range, the resistance becomes the new support, right? And if it breaks the support is going to become the new resistance. So that being said, go on TradingView and create a list of currencies of the major pairs and go over them and see if you can spot some supports and resistances and draw trend lines on them. So you can see if you can find some channels that will give you a general direction for that currency. This will give you some practice into looking at charts. And of course, don't worry if you don't spot them right away. This skill gets better with time as you look at more and more charts. In this lecture, we're going to be looking at volume. So volume is the other thing that you look at that's part of technical analysis. You have the charting, so the prices, because all of these come from prices, but you also have the volume. And the volume is this thing you see at the bottom. And the volume is basically the quantity of funds transacted, right? So the more money is transacted, the higher the volume is. Now, why would you care about volume? What would volume tell you? Well, does it make a difference if there's $1 billion that were transacted or $100 billion? Yes, it would, right? If you're looking at real estate and all of a sudden you see that prices of houses in your neighborhood increased because one guy bought a house at a very high price, does that give you an indication that prices will continue to increase? No, it's just one guy. But let's say all of a sudden there's hundreds and hundreds of people who start buying and selling at higher prices in your neighborhood. Well, would that give you an indication that prices are increasing? Yes. And sometimes you'll even see the volume, the quantity of transactions increase before the price increases. So you'll see that a lot of people are buying and selling, and then you'll slowly see prices going in one direction as there is more demand than supply, or supply than demand, right? So the quantity of transaction has an impact when, and is very necessary when prices move in a direction in a strong fashion. Otherwise, they might just revert, and it might just be because of a low amount of supply or demand. That's why something went up. Let's say there's 5 people who want to buy houses in your neighborhood, but nobody's selling. Then prices might go up, but it wasn't pushed up by demand. It was just a lack of supply at that time. So I would prefer seeing hundreds of transactions and the prices going up to tell myself, hey, it's demand that's pushing up prices and not a lack of supply. So in the same way, when you're looking at volume, you know that for directional moves, if there's a lot of volume, you have more confidence in them. And if you want a change in directions, it's also necessary that it comes with big volume. So if I look here, let's say I'm looking at Australian dollar here. Okay. Well, I can see here. Okay. So I can see here there's a spike of volume here. So volume was pretty low. And then at one point, prices really dropped. And you can see here that volumes really spiked. And then when volume spiked a lot here, we stopped. And then volume really kept on spiking and prices went back up, and then we recovered. And even here, you see that there's a bunch of volume. So volume was pretty okay. And then at one point, volume really spiked. And you can see that volume spiked actually here. You can see here there's a volume spike. Okay. And this is here, right? So prices hadn't even dropped. And then prices dropped with an increase in volume. So everybody was agreeing with that. There was a lot of selling, and that's what pushed prices down. And you can see then we had a change in directions. Oops. We had a change in directions, and prices started to go this way. Okay. And you can see that if you are looking at volume, that might give you warning that something might happen. And you see that volume's coming in, and you'll be like, okay, well, let me just step away and see what happens. And then when, we broke down here with high volume, then you might say, okay, well, look, we're breaking down and there's high volume. I think that this is going to keep going in that direction, because it's not just a few people or a bit of money that's saying that. It's a lot of money that's saying we're going in that direction. And then you might take a trade in that direction. So volume helps pretty much. So always have an eye out on volume, regardless if you're trading 1-day charts or if you're trading 1-hour charts or 30 minutes. When you're looking at volume, it might tell you when something is going on, right? It might tell you something is about to happen or something is happening, and you might want to take off your orders, not trade for that period, or wait until something happens and enter a trade in the same direction as the volume. So it's very helpful. So make sure you always have it on your charting.